Hello everyone. Financial instruments are among the most significant and complex elements in the modern financial reporting. Almost every entity, whether it is manufacturing, service, banking, or technology, has exposure to the financial instruments in some form. Trade receivables, borrowings, investments, derivatives, hedging arrangements, or financial guarantees. While Ind AS 109 focuses on the recognition and the measurement of financial instruments, Ind AS 107 plays an equally critical role by ensuring that entities provide transparent and meaningful disclosures to the users of financial statements. Objective of Ind AS is not simply to create the volume of disclosure, but to enable stakeholders to clearly evaluate two key aspects, which is disclosure and fair value reporting. So we are going to talk about this in more details in the upcoming slides. So let's move to the first slide, which is the agenda slide. Okay, so the key topics that you're going to cover today in Ind AS 101, which is financial instruments disclosure, are the objective and the scope, the key disclosure themes. The two significant disclosure areas is the significance disclosure and the risk disclosure. And under each of them, we have for significance disclosure, we have balance sheet disclosure, profit and loss disclosure, OCI disclosure, and fair value and offsetting disclosure. In risk and disclosure, we have credit risk disclosure, liquidity risk disclosures, market risk disclosure, hedge accounting disclosures, and transfer of the financial assets. And then we'll quickly have a look at the key differences, if any, between the IFRS 7 versus Ind AS 7. And this Ind AS 107 is largely, or not largely, in fact, is purely a financial instrument disclosure. It does not talk about the recognition and measurement, which is in the scope of Ind AS 109. So we're going to move to the first slide, which is the objective and the scope. Okay, now we are going to talk about the objective and the scope of Ind AS 107. Now, when we talk about the objective of Ind AS 107, Ind AS 107 requires entity to provide disclosures. So again, we are talking about the disclosure here. It does not speaks about the measurement or the recognition, which is in the scope of Ind AS 109. And these disclosures are there to enable the users of the financial statement to evaluate the significance of the financial instrument on the financial position and the nature of the extent of the risk. So again, largely the objective here is to make sure that whatever financial instruments are there in which entity is dealing, whether they are the financial instruments which are the investments or whether the financial instruments are specific to some liabilities, all these needs to be disclosed properly, and it has to be make sure that all the risks which are there on these financial instrument, those needs to be documented and clearly brought to the attention of the users of the financial statement. The standard focuses on the transparency and not the recognition of the measurement. When we talk about the scope here, the scope is it applies to the disclosure of all the financial instruments, including the financial assets and liabilities, which is largely measured under Ind AS 109, trade receivables and payables, loan, borrowing, deposits, derivatives, forward swaps and options, investment, fair value through OCI and fair value through profit and loss or amortized cost. And it excludes few of them, and which are those. So interest in the subsidiary, associates, joint venture, which is being measured under Ind AS 110, 111 and 28, and employers right and obligation, which is largely under Ind AS 19, and insurance contract, which is under Ind AS 117, which is yet to be notified by IRDA, but the current standard, which is Ind AS 104, is largely deal with the measurement, which is largely in line with the earlier gap. So objective and scope are clear. Objective is to make sure that the disclosures should clearly highlight the key risks which are there on the financial instrument, and the valuation is properly being done as per the measurement criteria and the recognition criteria of Ind AS 109. So Ind AS 107 is largely, not largely, in fact, again, it is purely a disclosure standard. So we'll move to the first slide. Okay, so the key disclosure themes. So basically, there are two set of disclosure themes that is being disclosed as a requirement of Ind AS 107. So two themes are significance disclosures, which is like how the financial instrument impact the balance sheet, P&L, and the OCI, which are the financial statements. And second most important is the risk disclosure, which is like it helps us to understand the kind of exposures that those financial instruments are having with respect to the credit risk, liquidity risk, and the market risk. And we are going to discuss about each of these risks separately in the upcoming slides. So two themes are there: significance disclosure and the risk disclosures. So we'll move to the next slide. Okay, now we'll quickly talk about the key significance disclosure. So first of all, we are going to talk about the key disclosure in the balance sheet. So statement of financial position disclosure. So entities must disclose the categories of the financial assets and the liabilities and the carrying amount under Ind AS 109. So when we talk about the categories here, so basically there are three type of the categories in which all the financial instruments are classified. Basis the model that is being adopted by the entity, and that model is largely being as per the Ind AS 109. So three models are amortized cost, fair value through OCI, and fair value through profit and loss. So carrying amount is again being the amount in which it has to be measured, and the measuring and recognition principle is again being lined up in Ind AS 109. But how it has to be disclosed, that is being something which is being taken care by Ind AS 107. So when we talk about the instrument type, so trade receivable is shown as the categorization as amortized cost. Bank FD is shown as amortized cost. Government bonds is classified either the amortized cost or the fair value through OCI, depending upon the business model. So if business model is hold and hold to collect, then it is largely, but not largely, it has to be mandatory classified as amortized cost. But if it is hold to sell, then definitely it has to be classified mandatory under FV OCI. And if it is specifically for trading, then it has to be mandatory classified under fair value through PNL. Mutual fund, listed equity share, derivatives and trading securities can either be classified as FV. So we'll talk about the mutual fund first. So mutual fund will be classified as fair value through TPL. Listed equity share can be classified under FV OCI, which is optional, but default is FV TPL. And this choice is made at the time of the recognition, initial recognition. So once choice has been made, it cannot be revoked. Derivatives and trading securities are classified as fair value through PL. So which means that all the category of the instruments which are largely for the trading purposes has to be classified as fair value through PL. The investments which are through purpose of the hold and sell both, then it has to be classified mandatory as fair value through OCI. But if it is hold to collect, which is like the objective is to get the principal cash flow back in the form of the principal and interest, then it has to be classified as amortized cost. So example, trade receivable measured at amortized cost is 50 crore. Mutual fund FVTPL is the 20 crore. So all equity instruments are measured at fair value through profit and loss. Equity can be shown as fair value to OCI only if the entity makes an irrevocable election at the initial recognition. So conditions for FVOCI elections, equity instrument must be not be held for the trading. Entity chooses FVOCI option at the time of the initial recognition, and election is irrevocable and cannot be changed. So if we are holding the equity instrument for trading, then it has to be classified as FV2PL. That is, there is no other option. But let's say if we are not holding it for trading purposes, we are holding it for long-term investment, then choices, oh, this is the entity. If they want to disclose it as fair value through OCI or fair value through PL, and if they have opted for, let's say, fair value through OCI, then it has to be irrevocable. Then it has to be classified through as the fair value through OCI. And once the once the investments are sold, the gain also is not which is reclassified into the PL. It has to be, so it's like the on the disposal of the investment, the gains are again recognized through OCI, and it will not be through PL. So this is the first disclosure, which is the disclosure in the balance sheet. Now we'll talk about the second element of it, which is the profit and loss account. So in the profit and loss account, largely we have to disclose all the income and expenditures with respect to the financial instrument, like interest income, interest expense, net gain or loss through FVTPL, if it has been classified as an FVTPL, impairment loss, which is the expected credit loss, and the fees income. And all these information needs to be disclosed with respect to the financial instrument, specifically for those wherein it has been classified as FVTPL, and for those which has specifically for the debt instrument which has been classified as FVOCI, the net gain or loss on the final disposal is again recognized in profit and loss account. So we move to the next slide, which is like disclosure in the OCI. Okay, now when we talk about the OCI disclosure, so other comprehensive income captures the certain fair value changes in financial instruments that are not recognized immediately in the P&L. Ind AS 107 requires OCI disclosure to help the users to understand which instruments impact the OCI, nature and the gain on the loss recognized, and whether the amount will be reclassified or recycled to the P&L later. So disclose the fair value of the gain and loss recognized in OCI, debt instrument at FVOCI. So any fair value changes in the debt instrument, it would be classified in the FVOCI if we have chosen FVOCI, and that FVOCI is dependent upon the business model. If the investments in the debt instrument is largely for the purpose of hold and sell, then definitely it has to be mandatory classified in FVOCI. So in which case any fair value changes on the reporting date would be shown under OCI. Equity instrument, if it has been taken a step that it would be classified as FVOCI on the initial recognition, and any changes in the value would be classified under OCI. Cash flow hedge reserves, and last one is credit risk challenges in the certain liabilities. Now, if we look at whether the on the final redemption or the final sale of the instrument, the reclassification would happen to OCI or not, that will depend upon the kind of the instrument. So if my instrument is debt instrument and if it is classified as FVOCI, then OCI would impact the fair value changes. But on the final redemption or the final closure of that particular instrument, any gain or loss would be recycled to my P&L. Equity instrument, if it has been classified as FVOCI, then OCI impact would be definitely accommodate the fair value changes, and on the final redemption or final sale out of those instrument, the recycling is not going to happen. Everything would be happen in the OCI only. Cash flow hedge effective portion would be again through OCI, wherein largely, so we have hedged the transaction like interest rate swap or foreign currency swaps. All these are like hedging transaction. It will be managed through my OCI. But if it has final settled, the final gain or loss would be shown in the P&L. But on credit risk and liabilities, credit changes, and this is classified in OCI, and recycling would P&L is not permitted. Specifically for those cases, this is largely for those liabilities wherein the liabilities value, the credit rating has been reduced, which means that our liabilities got reduced, and because of which there is a accounting gain for us. And that accounting gain is largely classified as on credit risk on the liabilities, which is got reduced, and hence it create an accounting gain to the entity. That would be accounting gain would be classified as an OCI. It will not have any recycling impact on the P&L. So this is the OCI disclosure. We'll move to the next slide then. Now we'll talk about the final one, which is the fair value disclosure. Now, fair value disclosure is largely to ensure that the equity instruments or the debt instruments, or for that matter, any kind of instruments, financial instruments, has to be disclosed at the fair value. And to make sure that the disclosure happen the fair value, there is a three-level hierarchy. This is largely in line with the Ind AS 109. Fair value of the financial instrument based on the fair value hierarchy. So for the quoted market, for the investment which are traded, listed shares, then we have to take the price as the quoted market price. If it is over the counter derivatives, then we have to get the observable input basis the private placements. And if it is like private equity valuation, then unobservable inputs. This is largely with respect to the new startup for which we do not have any public available information. So in that case, valuation happens basis the input that has been received. Now, final disclosure is the offsetting disclosure. This normally happens if the financial assets and liabilities are offset, which is like net presentation is permitted for that particular financial set of the financial instrument. So what we have to do, disclose the gross amount, amount set off, and the net exposure. This has to be disclosed. For example, receivable is 10 crore, payable 4 crore of the offsetting arrangement, net exposure is 6 crore. All these to be disclosed properly so that the users of the financial statements are clear that what is the total exposure, net exposure to the particular financial instrument. So with this, we come to the end of this significance disclosure, which is like disclosure on the presentation side of it. Now we'll move to the next set of the disclosure, which is largely associated to the risks. Okay, now this is the second section wherein we are going to talk about the risk disclosure. The first type of the risk in the risk disclosure is the credit risk disclosure, wherein we have to show the risk of the counterparty default. So typically, what kind of disclosures are required under this category is the maximum exposure to the credit risk, the aging analysis of the receivables, the credit risk concentration, and the expected credit loss, which is the ECL methodology. So, for example, the trade receivable is 50 crore. past due greater than 90 days is 5 crore and the ECL provision is 2 crore. So this has to be disclosed to ensure that the users could able to interpret the risks which is attached to the financial instruments. So we'll move to the next slide then. We have come to the second one in the risk disclosure, which is the liquidity risk disclosure. So, liquidity risk disclosure is largely associated with the fact that inability to meet the obligations when due. So, which means that organization does not have the liquidity to honor the liability that falls due on a particular due date. So, entities must provide a maturity risk analysis of those liabilities. So, typically, they have to disclose the liability basis the aging bucket, which is less than a year, 1 to 3 years, and the greater than 3 years. So that this clearly shows that the exposure the entity that has to meet the exposure at a particular date and also helps the users of the financial statement to interpret the liquidity position of the organization. So this risk helps to evaluate how strong the liquidity position is and the users can take the judicious decision accordingly. So we'll move to the next slide. Now, the third risk that we have to disclose as a part of the risk disclosure is the market risk disclosure, which is largely when entity is having the exposure to the market, specifically in the derivative section, and there are interest rate risk, there is currency risk, and there is the equity price risk, and all these risks needs to be disclosed appropriately to make sure that users could able to interpret the financial statements accordingly, and entities must disclose the sensitivity analysis and the risk management approach. So example, interest rate sensitivity, a 1% increase in the interest rate would reduce the profit by 0.8 crore. Example, currency risk of USD payable 2 million and average depreciation at 5%, loss of 0.6 crore. So typically, these disclosures are largely required to ensure that entity has proper disclosure, and those disclosures are such that they could able to help to evaluate the risk which entity has with respect to the foreign currency swaps or the interest rate swaps, or for that matter, any kind of risk which is dependent upon the market scenarios. So all these needs to be disclosed so that users will be able to understand the kind of risk that is associated to the financial instruments. Now, next risk is the hedge accounting, which is largely again associated with the derivatives. And how we have to disclose is that we have to disclose the risk management strategy, hedging instruments, and the hedge effectiveness. Whenever we have taken any hedged contract, we have to make sure that the risk associated to it has been properly disclosed so that users are clear that what kind of risk those financial instruments are carrying. For example, forward contract hedging USD imports and the hedge reserve movement disclosed in the OCI. So, objective to disclose all these risks is to make sure that the the accounting standard, which is largely for the disclosure, and it covers the two significant disclosures, which is the significance risk, which is the how disclosures needs to be happen on the financial statements, and second is the risk associated with the market risk, liquidity risk, or the credit risk. Those needs to be disclosed appropriately. And then we move to the last category of risk under this section in the next slide. Okay, so the last one is when we have securitized an asset or we have factored an asset, then definitely it also carries a kind of a risk wherein we have to disclose the nature of the transfer, and then we have to ensure the continuing involvement of the entity to manage that particular factoring or the securitization agreement. So example, trade receivables factored with the recourse, continuing exposure disclosed. So basically, whenever we have factored any kind of the receivables, then we have to pay some factoring commission, plus it has an inherent risk associated to it, whether the amount is going to get received or not. Then we have to disclose that kind of risks appropriately so that users are clear that what kind of risk they are carrying for those particular set of the financial instruments. So this we with this we actually come to the end of this Ind AS 107 presentation. So last slide we are going to talk about is the differences, if any, between the IFRS 7. Now, when we try to compare the Ind AS 107 with IFRS 7, we do not find any differences as such. They are largely converged. So objective, risk disclosure, fair value hierarchy, and the hedge disclosures are in line with the IFRS 7, and there are no fundamental and conceptual difference between them. So this actually comes to the end of this session. We are going to talk about the key synopsis of this session in the final thank you slide. Okay, so we'll come to the final thank you slide. So let us just quickly recapture what we have learned in this presentation. So a major takeaway is that Ind AS 107 is not about the boilerplate compliance. It is about the communicating risk and financial reality to the stakeholders in a structured and the comparable manner. So in today's environment of increasing complexity in the financial markets, these disclosures plays an important role, not only for the accountants and auditors, but also to the investors, regulators, analysts, and the finance leaders. So I hope this session has provided you with the clear and the practical understanding of India's 107, enabling you to interpret and apply its disclosure requirement with confidence in both the examination and the real world financial reporting context. So thank you for your valuable time and attention. I will be happy to take any questions through the comment section. Thank you for watching this video, and we're going to come up with a new video on the Ind AS very soon. Thank you and have a good day.